What is going on, Hot Take Nation? It is David Ramsden-Wood here for another episode of the Hot Take of the Day podcast. And this week, I am very fortunate to be joined by the president of Exponent Energy, Chris Bird. Chris, how are you doing today?
I'm doing really well. How are you?
I'm doing great. So I've been looking forward to this interview. Probably, I bet it's been 18 months, but it's March 29th as we're recording. So this is going to come out the first week of April. So I want to flash back about a year. There was an article on yourself, Billy Bailey, and one other that had been positioned short going into the coronavirus crisis of Shale. And I want you to just give the listeners some context to what it is that you're doing and what it was that you saw. And let's go back to those dark days, although happy days for you, but very dark days for most of the rest of the industry. Take it away.
Yeah, I think, I was really surprised that the market had not responded by the time that it did, which I remember it was March 6th was that Friday where we saw the big turn down, and then, equities really got hit that Monday also. But, starting in December, January, we started to get short, and I was expecting it earlier than it ended up actually happening. And honestly, it was just really luck, because that week going up to March 6th, we were standing around looking and like, what is going on? Like, how is oil price hanging up where it is? Nobody understood it. We didn't understand it. And so, we just kept adding and adding and adding. And it really, we're lucky that it progressed the way it did, because we were able to get the position bigger and bigger as our confidence level kept going up. And, we had actually put on some pretty sizable, we bought some put options that like week. And, we were hitting some like 6 and 8x numbers on some good sized put options that we had put on earlier that week. But yeah, it really wasn't more complicated than that. We just saw the coronavirus. We knew demand was going to get smoked, and we didn't think the market had responded appropriately. And so that was it.
Yeah, it is amazing. Timing is everything. And I remember, like you, looking at it in January. The U.S. had assassinated an Iranian general on January 3rd. Oil was 63. And over the course of even the next 30 days, oil came back 20% and the S&P was up 4%. And I remember saying, well, the fluid that drives the world economy is trading as though something bad is happening, and the S&P is trading like something really good is happening. And it was super confusing. Obviously, the Russians came out, did smash one on Friday. The Saudis came out and did smash two on Saturday, and Monday looked different. So, but you had been a critic, I would say. I think that's a fair statement of Shale, even separate and apart from the coronavirus and demand destruction. How has that view evolved over the last year? If you watch the talking heads on CNBC, they'll certainly say things like, oh, well, now oil is investable because it's just run so much differently than it was before. They're focused on free cash flow, et cetera, which I think is laughable. But I'm curious your opinion on that.
No, I completely agree. I think that, there are certain metrics, of course, there are trades that can be made. I've made them, myself over the last 5 months. And, I always tell people that it's a trade and not an investment. And, there was a good setup for oil price to go up. And, that the names that have been hit the most, the ones that were the worst in terms of debt ratios and things, were going to respond the most. But I always say that at the end of the day, I can't find a shale company that has an absolute value metric that actually makes sense from the standpoint of, what is the value of the underlying assets that this company owns, combined with the future opportunities for drilling that they have, and the risk of, oil price and how all that moves around, and does it actually translate into a value proposition. And the way that I think I can break it down the simplest, to me at least, is, we own and operate wells, oil production. And, I can go into the private market and I can buy production for a third to a half of what I can pay in the public market for an enterprise value of a mid-independent, And so to me, that that tells you that there's a big disconnect between like people that pay for things based off of value and what's happening in the public market in oil. So but that's not to say there's not trades to be made and still to be made. And I am bullish oil price, and I think that but there's room to run on a lot of those names for sure.
So let's talk about that, because it is a really nuanced point, right? Is that, and you and I have certainly been on the same page that from a fundamental valuation standpoint, no matter what method that you use, the underlying NAV of a public company is far in excess, or the share price is far in excess. Add debt, burden G&A, and you sort of say, why, a lot of these companies shouldn't exist. And yet, on November 9th, I believe was the day, the vaccine news hit. Oil had hit $35, and it went effectively in a straight line over a 4-month period, straight to 65. We've had a little bit of a pullback recently, but how do you balance the timing? Like if you macro the next 3 years, you've been long currently, you're saying effectively, I'm going to get short again, but right now I'm bullish oil. How do you think through that timing in the trade, and what was the key for you to be right when you went uber long in November, which I know you did?
I mean, I think that a lot of people try to time things like precisely, they get caught up in all the noise and the EIA data and every month of OPEC meeting, and they want to talk about Iran, and they want to talk about 1 million barrels here and there and daily supply and China demand and all these things. And it's all fun to talk about, but like, I think you have to step back, and this is my take, is you say, I can feel confident on some timeline that oil price will go up dramatically. And so, what is your timeline? Or, I mean, I'll make that assertion myself. You don't have to agree with me, but I make that assertion. I say that, in 2 to 3 years, my confidence level that we have $80 oil like approaches 100%. And so, and we can get into the specifics of why I think that. But if you have that take and you say, okay, well, what would be the response of this stock in 2 to 3 years if we have $80 oil? And you could say this one triples, this one doubles, this one does whatever response in that timeline. And then you can just say like, okay, so I've got that endpoint. I know that that's true. That's my investment thesis. That's my base case where I can feel comfortable, and I can know that within that timeline, I will feel like I did well for myself and my investors if, we've compounded 50% each year between now and then. Now, there's going to be noise. There's going to be ups and downs. There's going to be 10% down days and 10% up days, and you just know it, and you just have to have the fortitude to just stay the course, and you just have to have that confidence. And when you have that behind your thinking, and then you just know that, and you just say like, oh cool, like sure, I'm going to check my prices every day, of course. And we do get judged on the short-term moves, of course, too. Everybody does, but just take that view, feel confident, stick to your guns, find the names you like, and just go, just hold. And that's my approach. That's why I look at it.
So before we talk about one specific name that I've really wanted to chat with you about, let's talk about the macro overlay, right? Because I think it's fair to say over the last 18 months, I mean, the no surprise, stocks trade as the commodity goes. And if you're right on the commodity, you're going to be right on the stock. And as you said, the timing is always in question. But you said something, you think oil goes to 80 in the next 2 to 3 years with a very, very high level of confidence. I want to talk natural gas at the end of this conversation, but let's talk oil right now. What is it in your thesis that's making you feel oil hits 80? And what risks are there to that view?
I mean, I think there's 2 ways to approach oil price, of course. You've got the barrel counters and you've got the macro, right? And so 2 separate issues, but to me, they both draw the same conclusion. Of course, the macro questions are way more esoteric and subjective, but like, the barrel counting is, easier But you could come down, and of course on the barrel counting side, it's easier to kind of quantify and understand supply than demand, because demand, we're just working with the reflation of demand into where we were before coronavirus hit, and then you're talking about mutations of viruses and all sorts of vaccine implementations, and so in the short term, again, I think it's just noise. But like, can you say that okay, so for specific example, now we're seeing America demand go up, gasoline is coming up, jet fuel usage is going up, it's up 50% since the low. And so now everybody's getting caught up in Europe issues. But if you really look at where demand was coming into the market, where it was growing before coronavirus, it's India and it's China. I mean, and so are India and China going green? Are they going to stop developing? Are they going to stop growing? No, they're not. They're going to keep growing. They're going to get back to demand levels they were before, or are already, and they're going to grow. And so, and I frankly don't think that they're incredibly that interested in the green tech space anyways. And so, I can come to a conclusion that the world will heal, the world will go back to the demand levels, at least where it was, right? And so then you can just say, all right, so what does supply look like when demand gets back to that level? And let's pick a date, let's say, a year from now. And so you're going to say the United States has lost 3 to 4 million barrels a day at that point, right? You're going to say that non-OPEC's lost 2 million. Well, OPEC's lost 2 million of just natural decline, right? Non-OPEC's lost 3 million. And so, when you add that up, you can easily come to a picture that we are now in a supply demand balance to constraint at that point right there. And, so that's barrel counting side. Macro side, probably less interesting to your listeners, but I would say that, we probably, this is again, is very subjective, but the balance in accounts in the United States has run 3 to 4% historically for 40, 50 years. And when you see that it stayed that way all the way through the coronavirus pandemic, I think, while we added $1.4 trillion of savings. And so what does that mean? In my opinion, that, when the 1.4 trillion gets spent, because we're not Japan, we spend money. And so when that gets spent and you see like normalcy return back to American performance, then you're going to just see that, the balance of payments in the United States current accounts going to go up to 6%. And, when you see that, you're going to start to allocate a lot of growth, and you're going to see a lot of overperformance in the emerging markets, 2002 era type, emerging market, blow up of, the Vietnams and those places start to perform well. And guess what, who takes all the oil in the world, right? I mean, it's who creates the demand. When we create an incremental dollar of GDP growth in the United States, we don't generate a lot of demand for that incremental dollar, but, when Botswana does, they create a lot of demand, because that guy went from living, and walking to work or whatever, to buying a car and driving it, and it's a fully different picture. So, and again, I said, it's a lot more esoteric to think of that picture, but I think that broadly speaking, you start to see the emerging markets grow, and you start to see developed markets start to decline or stay flat, basically.
And so do you think, I mean, if oil hits 80, then, I mean, clearly now we would both agree, I think, that there's declining value in shale inventory in the United States, that we've worked through a lot of the tier one, that obviously service costs are going to come up a lot, because service companies have just been absolutely fed the fist for the last year and have been basically giving everything away just to keep any ability to have people. I've made some jokes in some of my speeches that if I were a drilling company or a frack company, I would try and buy all the equipment and take blowtorches to it to make sure that there aren't 800 rigs available and that you can always be undercut. But if we hit 80, what happens in the world dynamic of some of these declines? And do you see Saudi accelerate? Do you see the Russians accelerate? Do you see the fall apart of OPEC? Do you see such levels of cheating that you really, come back into a range? Or what do you think happens if we do touch 80? Is it touch 80 and stay at 80, or is it touch 80 and kind of be a 65 to 70 commodity?
No, I mean, I would probably argue the other. I mean, I think 80 could start to look conservative in most a lot of scenarios. And I mean, you hit it. It's if you look at the last 10 years of capital outlays on major projects, it's the lowest that it's been in 40 or 50 years, inflation adjusted for, long lead time oil production projects. And so, none of that's coming to market anytime soon. And so, what do you have to create an incremental barrel at that point? And Saudi increasing production, it's an interesting concept. But if you go back pre-coronavirus, they were running 200 rigs basically to keep production flat. And if you look back historically, like if you go back I think even 10 years before then, it was like 20. I mean, the amount of rigs they've been running grow exponentially, and they were just doing it to keep their production flat. And so there's base decline happening behind the scenes that we're not talking about and they're not talking about. And their fields, of course, are very different than our fields in the sense that, they're great rock there. But what they do when they're producing these things is they're shoving water into the ground over here and it naturally flows up into the well next door. And there's just a limit on what downspacing in a field like that's really going to get you, like in Guar. And so I don't think that those countries like that, the OPEC core can really grow. Of course, you've got places that are, economic disasters like Venezuela, that have opportunity to grow. You'll see growth there, but how impactful is it and how significant is it and how fast does that come to market? I don't think that we're talking within the, timeline we're talking, which is 4 years or something. It's just too much lead time. And so, yeah, I mean, shale, of course, I think the inventory question, I think people get this wrong all the time. And people will say, oh gosh, people have been saying we're running out of inventory for 5 years. And the right way to think about it, to me, it's not a question of running out of inventory because you can drill an infinite amount of wells in a section. I mean, really, you can drill as many wells as you want and you will increase production probably with every well at, within some reasonable limit to, and you will do whatever, but you're not actually creating reserves, right? Like you're not actually adding more total barrels out of that unit than you were previously. And so, that has an effect on where, well, okay, so you've accelerated your reserves, you've increased your rate of return, you've decreased your return on invested capital. And so, within the calculation, and you're an engineer, so you run this calculation. So if where you say like, well, where does accelerating reserves make me more money, right? And where am I willing to lose a return on invested capital to get a higher RR to capture a higher oil price? And so there's definitely going to be that, but you're going to start to see, you're already seeing it. I mean, if you look specifically on wells, you're starting to see that 30-day IPs and things are starting to roll, of course.
And 12-month cumulatives, I mean, even going back a year and a half, you could see that, at least from my data, with the exception of the Bakken, which we're going to talk about now, 2016 was really the peak year in terms of cumulative 12-month performance normalized per lateral foot because you're drilling closer, so impacting terminal declines. The Bakken was the exception. And I think in part because it was relatively consolidated and there were guys like Exxon and like Conoco who maybe weren't pushing the envelope quite so much. But one of your favorites, which I thought initially was a joke, and perhaps it could be a joke, but it has transcended from a joke to not a joke. And that would be Northern Oil and Gas. Nick O'Grady has taken over there. I think by all accounts has done a pretty nice job for where they're at. And so the Twitter, I'm going to call it joke, but the Twitter, they love the Nog. Tell us the view of Nog and how it started and where it's going.
I mean, it was a joke in the sense that, we made it a joke because it was funny, but I wouldn't have ever, made some statements that I did make about it, which, implied, of course, that I was long the stock and that it was actually a decent trade, which it was a decent trade. It is a decent trade, actually. I mean, and so you just have to, back up and say like, well, again, like you got to like have your brain bifurcated. It's like I got trades and I've got investments and where is a trade makes sense. And if you look at the guys that trade, the day traders and the algos and whatever, and these guys that, frankly, I think are idiots, but, they're going to drive the market for some time frame. And so what do you want to do? You want to hook your horse to their wagon and, participate. And so, where the simplest, easiest metric you can break it down an oil company to is enterprise value over EBITDA, right? And so like you could just take any company and let's just forget about what part of the enterprise value is debt, which part's, market cap. Let's just take it simple as you can. And you just say like, okay, I'm going to look at a peer group and I'm going to say like, what metric, are the traders going to look for? And that's the one, that's what I'm looking for. I want the cheap one. Why is it cheap? There's some things about it that people don't like. It's non-op. It's the Bakken, which is old and dead, or whatever people say about it. And so it was a simple like, well, this simple metric that everybody uses, and all the people that are going to reflate oil equities is going to use. On that sense, it's a cheap number. That case makes sense. Now, if you want to talk about investment reasons why it made sense also, everybody that doesn't know what they're doing looks at 2 barrels a day production is the same. And they say, okay, well, I got a barrel coming out of the Bakken, and that's the same to me as a barrel coming out of Midland or Niobrara or Eagle Ford or whatever. But, with somebody like Northern, which is in a more mature part of the decline curve, right? I mean, if you've got this massive, like, are you up here? Or are you down here? And NOG is down here. And so that natural decline rate is just a barrel of production is worth more to NOG than it is to somebody that, just drilled their wells last week. And that was my argument. That was my case. Of course, it moved against me for a while, and then, now we're back, of course. How big of a position was it for us? Not that big. We played the reflation high beta trade like pretty minimally, honestly. Like I've argued the whole time as a big picture item, like I'd rather be long quality, even though I knew we'd lose a little bit in the short run. Like sure, I'll pick up a couple names, but like, when you start to factor in long-term capital gains, you start to factor in, like I said, that 2-year timeline, you just say like, I want something I can stick to, I can sleep at night. And so, our biggest positions were nothing like energy, the truth. So,
but a position nonetheless.
Yeah.
It raises an interesting point, because I believe the decision is coming down April 9th is my last check, but on the DAPL ruling. And not that the president is the guy in the room making the ruling, and not necessarily that judges are going to rule based on political stances, even though they do. I'm curious what you think comes out of DAPL, and if that moves the market at all, or if it's priced in. And this would be for all Bakken players, but also just, the Keystone pipeline getting cut, and where Canada felt, and a huge amount of capital was invested. And what does it do for, future infrastructure projects if it turns out that the government can give approval and then withdraw approval after the pipeline's been running for 3 years? Because I think a lot of people who aren't familiar with the DAPL story don't know that pipeline has been up since like late 17 or early 18, which is very different than Keystone. Keystone, they were kind of pre-building ahead of some approvals. Whereas DAPL, I mean, it has been flowing kind of 500,000 barrels a day for a while. What's your take on that, and how closely do you watch that story?
Oh, I mean, I've watched it, and I think it would be a really sad day for America if we shut down a pipeline, perfectly good pipeline that we built and that workers depend on, and decreases our fuel costs and increases the safety of transporting a barrel from North Dakota to the Gulf Coast, which is what we should all care about. Of course, there's ways to promote the green trend is here to stay. It's stupid to think we're not moving in that direction, and we're going to keep moving in that direction. It's going to keep getting worse or better, I guess, whatever you want to call it. And that's just the way of the world, and so we have to accept that. But what does it mean when we start coming in and start saying that, things that, like you said, we've approved this, it's been running, it went through the steps necessary, and they got the correct permits. And to me, it's really scary that you never want to introduce a lot of uncertainty into business-minded citizens, and the worst thing that you can ever do for people that you want to invest capital. I mean, our entire tax structure is based on trying to incentivize people to put money to work. And you never want to take that incentive away. I mean, that's what makes has made America great for the last 400 years. I mean, we've private citizens putting their money at risk to develop projects to, become wealthy and reap the benefits of doing that is what we've thrived on and done better than anybody else. And so you can't introduce that uncertainty I think, to me, there's been several examples. It was, when Obama primed the GM bondholders and basically chose who got to make the money and who didn't, that was a big one. When we obviously long-term capital, when we bailed them out, these are moments that have deteriorated America's ability to be successful. And I think if you were to do that with Keystone, you would be in that classic category. I mean, you've got to keep Americans believing in the system. I mean, it's psychological. And so I really hope they don't cut it. I don't think they will, actually. I think that it's a lot easier to shut down a pipeline that's not built than to shut down one that is. But
especially there has to be some level, and again, I'm not saying politicians make the decisions, but oil at 60, I mean, we're seeing gasoline prices at the pumps at levels we haven't seen in a while. You add the Suez Canal, you add some OPEC tomfoolery with keeping production off the market, you add the Texas freeze with the refineries going down. I mean, there is a lot that coming into May driving season, when theoretically everyone's vaccinated, when they start seeing $4 gas at the pump, and if we're not doing everything we can to encourage relatively lower prices, certainly the shutdown of DAPL would add, putting that stuff on rail, I think is 10 or 15 bucks a barrel. And it's a huge differential that, consumers will end up paying for one way or the other.
That's right. No, I agree. Yeah.
So let's talk natural gas. With there was a time in the last 6 months. I mean, it's actually crazy. I remember gas was $3.30 and it was the running of the bulls, and then it's pulled back 80 cents, as natural gas always does. And so now it's trading at $2.50. And I'm curious what you think about natural gas. And as I recall, you're an Oklahoma guy, and natural gas is a very, like, liquids, and natural gas is huge to the Anadarko Basin, to some of those plays out there. What do you think is going to happen on the natural gas side, and why do we keep seeing this massive pullback to levels that are just barely sustainable from economics standpoint?
Yeah, I mean, I joke that natural gas has been breaking my heart for, my 15-year career, over and over again. Might even call it a sucker bet at some point, because it just never performs. But just when you say that, that might be the moment where actually there starts to be a case to be made. I mean, I think the intrinsic problem is that you have have had, and still in some sense have an almost infinite supply of gas at a certain price level within the timelines that we would be discussing. And it's been the Marcellus, it's going to be the Haynesville, and with a certain price, people will add rigs quickly and add gas to market quickly, and it makes it hard to see a true run that has any duration attached to it. Now, you have seen, the companies that are natural gas predominant, you've seen their, cost per MCF generated reserves has dropped, and it's been impressive. I mean, that's been something that I've seen over my career that's really blown my mind. I would have never expected. I started my career in the Haynesville, and the EURs of those wells and the time it took us to drill them, and how many operational difficulties and all that we went through back in 15 years ago or whatever, and how much harder that was than it is today is incredible. I mean, it was hard to drill the wells. It was slow. We were over a month, month and maybe even 5 to 6 weeks because I started there. I mean, we had just completed, I don't even know, maybe 5 to 10 wells at Chesapeake when I started there. So it was early on, but I mean, we had so many operational issues. We blew out wells left and right. I mean, just crazy. And now it's just easy on repeat. Press the easy button. How many wells do you want? And not only that, but I mean, you've seen those EURs go from, call it 4 to 4.5 BCF to 14. I mean,
Yeah.
triple them. I mean, that's incredible. And my old rule of thumb when I started in the business was that, in BCF of reserves was worth $1 million, and now it's maybe worth a third of that, maybe. And so it's just the whole game's changed, and I can never get excited on a long-term view on gas because of that. Are there going to be short-term, constraints and all that? Sure. I mean, does gas price have a natural point that it makes sense and probably settles out as a little bit higher than where it is today? Probably, yeah. But
So let's overlay something that has been in the background of our whole conversation, which is the green tech, the Green Deal, world demand, the role of natural gas, quite frankly, in reducing CO2 emissions. And I'd written a blog a couple months ago that sort of said, look, I've come around in the last few years that we should stop beating our heads against the wall. We're never going to win in the court of public opinion. We can only probably win in the courts. And that the industry should itself shrug and stop saying, I want to provide affordable energy, because that's not really the goal. We want to make good returns. And the irony is, when gas and oil are cheap, consumers hate us for the impact on the climate. And when gas and oil are expensive, they hate us for price gouging. And we really have like no win. And then you overlay this Green New Deal and this infrastructure and wind and so the whole thing. Where does that play out for demand, and do we get to a happy medium in your view, or is as the political landscape is right now, we have to keep going down some major extremes and have more frequent California blackouts, more frequent Texas blackouts, more frequent utility bills that are 10, 15, 20% more expensive month over month? What is your take on how this all plays out in the next couple of years?
well, I mean, it's frankly, we have, if we want to get political, my take, we've let people get in charge that should never be in charge of anything. I mean, some of our major politicians shouldn't be running a Dairy Queen, let alone, major budgeted committees and things like that. And it's sad. It's political. It's frankly, you're questioning how dumb can this country get before we start to realize that we're being dumb. And I think it's going to be a lot worse, honestly. And I don't even really have hope that we do have some sort of flop back. I just think that, to get way out there, but historically every empire has declined, and we're in the decline phase of our society, and there's no way that that's going to just roundabout turn and we're going to go back to the way things were. Because if we were going to be logical about it and we were going to do things the right way and we really cared about the amount of CO2 emissions, then our approach would be completely different than the way it is. I mean, you're right. I mean, natural gas has been the driver behind cutting CO2 emissions. Replacing coal has been what's done that. And, but what else do? We make it so restrictive on, environmental and employment law so that you move all of our jobs to China, where they burn coal like crazy. So you want to now make products in China and buy them, ship them over the ocean in a nice bunker oil powered ship, and use coal, and not only that, but have it where you have no influence and no ability to regulate at all now, right? And they'll tell you whatever you want to hear in the Paris Accords or whatever. They don't care. I mean, I think it's really just, it speaks to the level of, I would say, lack of, experience and exposure with humans, like if you have not really like gotten down to the point that you understand that like somebody that was one generation away from starving and a farmer in China gives a shit about CO2 and global warming. If you can't just intrinsically know that, then you just you'll just gonna live in ignorance, really. And that's what is happening in our country. We have people that live on hopes and dreams, that have lived a sheltered life, that have never seen anything besides the walls of fancy Ivy League and boarding schools, that now are in charge of government institutions, and they just don't know. They just don't understand. They cannot relate to the way that somebody in China thinks about CO2 and global warming, and
Right.
they're just never going to get it. And are we going to go back to like letting adults run our country? No. Like, we're going to let the children take over, and we're just going to have to go through that process, and it's going to be painful. And I just hope it takes longer than, I hope the rate of acceleration, the second derivative of where we're moving right now, decreases, because it's moving quick, in my opinion.
It is, and actually, I'll give Bill Maher a little credit. I don't watch him a ton, but there was a clip circulated on China, and I think that there was like a Dr. Seuss book, and it had like this what a white, rich, elite, wealthy American would perceive as racist. Had this like Chinese person like running around, and he said, "You know what the Chinese people think about this? They don't, because they don't care, because they're just going out and whooping our ass." And
Yeah.
it's so it is really true, and it's troubling, because even when you see what happened in Texas, and by by proximity, what happened in Oklahoma, what happened in Colorado, XL Energy saw $1.2 billion of increased cost for natural gas purchasing over those 5 days, because it was cold everywhere. That was 10% of their entire revenue in 2020. And that's going to be passed to consumers, and no one cares. And over the weekend, Warren Buffett had pitched, I guess, Governor Abbott, that they were going to build some natural gas standby plants. But without hedging and without like supply in storage, it doesn't matter whether you have the plants to burn the gas. What matters is, do you have the commodity to burn? And that's the thing that is going to continue to get more and more expensive in these demand surges when we rely on wind and solar. And it feels like no one's having those conversations.
No, they're not happy.
What do you do for fun? And I wanted to ask, just as a personal thing, what do you do for fun? I see you golf occasionally, you play a little tennis. What do you do to kind of free your mind from some of the craziness we see in politics these days?
I do play tennis once, twice a week, call it. That's sort of my exercise, my cardio. I've started going to the gym actually again, probably the first time in 15, 20 years. I've started to lift some weights and things again, but that's certainly not a normal activity for me. I just started to realize summer's coming up, and it might be nice not to be fat. And
Yeah, the bikini weather. I find I don't look nearly as good in a bikini as I did a year ago today. So I'm definitely trying to work on that. When you look at the stimulus, and I'm sure you saw over the weekend, again, Biden's now talking about another stimulus package in April, which I can't even. And then the infrastructure bill, and then we're passing all these things. So what is your take on infrastructure? And at some point, this comes down to tax, right? We saw the Trump tax cuts lowered the top end rate from, I think, 39.6 to 37. The obvious one is this wealth tax or estate tax, step up in basis. We're hearing all of these things. What do you think comes of that? And any projections for when the stimulus and the free money printing stops, and we start to think about balancing a budget or whatever it is that we're supposed to do for future generations, your kids and mine?
I don't know, man. That's really hard. It's like I told my wife, it's like, now that we feed our dog the expensive food, we'll never be able to go back to the cheap stuff. It's done. how do you untrain people to believe that the government should be handing them checks, regularly? It's a lot easier to never go there than it is to take that away. And I don't think we will. I mean, I think, um, we will probably pay directly for the rest of our country's existence, people and institutions that we have deemed to be worthy of receiving that payment. And
So like a universal income, the Andrew Yang sort of freedom checks, $1,000 a period, were just that, you think that that's the way forward?
that's going to be the new normal. Yeah. I mean, because, people proved, and I don't know. I mean, the Georgia Republicans were weirdos, so I don't want to draw too many conclusions from that. But if you look at there's some pretty funny montages and sound bites from, the Democratic candidates. And it was just like, we're going to give you $2,000. We're going to give you $2,000. We're going to give you, just each one of them, every time they were up on stage, they're just saying, we're going to give you $2,000. We're going to give you $2,000. And that's become part of the expectation. And people have now realized, oh, well, I can just vote for the guy that offers to pay me the most amount of money. And, some Republican came back later and said, well, I want to pay everybody 10 grand, And so oh, well, that guy's going to give me 10 and you're giving me 8. So I'm going to vote for him. And, how do you ever break that? I don't think you do. I mean, honestly. And so, yeah, I mean, you'd say well, in a historic or in any other institution in the world, we would say that we need to figure out a way to pay for that. But, because our government can choose to create as much money as they want, I would expect that that is what they will do. And I don't think that there's a plan to pay for it. I don't think there's an ability to pay for it. And, does the dollar start to lose value 100%? I mean, does the rest of the world decrease faster or slower than us in terms of, how fast they're printing money? I mean, I think Western Europe is a third world country in a decade, and I think that we're probably 10 to 15 years behind, or 20 years maybe behind Western Europe. I mean, they're already well on their way, and so, will the yuan outperform the dollar over the next 20 years? 100%. Or the corona, the Norwegian krona or whatever kroner, outperform 100%. I mean, just a fact. And I don't know what else that America can do at this point besides we as Americans and rational Americans maybe that just be upset and sad about it and just know that it's just going to be the way it is, and you just kind of need to accept it and move on. And I don't think they're going to pay for it now. I mean, they're not going to do any of that. They'll just print and print and print until we devalue the dollar till there's no value left, when hopefully that just takes a really long time.
So what do you do with your money to protect against that? Or are you just are you of the live and let live? There's really nothing I can do about it. There's no stress that I should incur about it. I can make some macro trends on the yuan doing better than the US dollar, which totally makes sense. And then just you live your life and figure things out.
Yeah, well, I mean, again, it's a long timeline. That's going to take a while, and I don't think there's a logical thing to do right now with your money that makes sense. Is there going to be a point in time where you're going to want to have your money in something besides dollars and dollar denoted asset? Probably, yeah. I mean, I hope that's in 20 years, but there will be a time, and the people are, you're going to be sad that don't. How you play it, I mean, I've got a pretty good collection of metals. I'm like probably a weirdo when it comes to what portion of my personal net worth is now in little bars of gold and things stashed away at a bank. I just feel good about it, and it's something that when you die, you can give to your kids, and it's kind of a hobby too. I do metal work. I'm actually going to melt a 1,000-ounce bar of silver on Wednesday with a couple of buddies. Just it's kind of what we do. I mean, I don't know. So yeah, I mean, for now though, you don't want to be long, growth. You want to be long value. That's going to be the rotation that happens. Assets that are cash flow producing, oil, metals, all that. That's Altria, tobacco, right? Your stuff like that that's been hated. That's where you're going to make money for the next 10 years, I think.
Well, I love it, and I appreciate the insight. We certainly live in interesting times, and to think back over the last 365 days and really 540 in the energy space in particular, it's been crazy, and I can only imagine it's going to get crazier. So I appreciate you sharing your insights today and coming on the podcast. I look forward to a day when you and I can do a golf and tennis and ping pong day, because that should be fun. I really want to throw squash in there, but I don't. I think you'd be clever to avoid that.
I mean, I can do some racquetball. Maybe we could compromise.
Like racquetball, that's a very hilarious game. I apologize for all those racquetball players out there, but as a squash player, I've never been able to figure out what's going on in racquetball. It just hit it as hard as you can at the front wall and see where it goes.
That and just get out of the way when the other guy hits it. That's the other part. You don't ever want to get hit in the back with a racquetball.
No, you do not. Well, Chris Bird, thank you so much for joining us today.
Absolutely. Thanks for having me.
Until the next episode, be safe, be good, have a great day, and bye for now.